All right, guys, welcome back. Another to the chart talk. Kicking off the week again. We had the market close yesterday for MLK. We had some fears over the weekend, with some geopolitical issues. We got us trying to buy Greenland, and we had some, a little bit of a gap down we walked into today. So, I'm highlighting here kind of the key areas of where we might see some buying come into play. Again, we're seeing headlines of like the S&P is giving back its gains for 2026. We're 2 weeks into the new year. we closed at new all-time highs, a couple days ago. If we zoom out a bunch, if you bought the market anytime in the past, you've made money. This is where we're at. So it's hard to, complain or be upset about it, a little 2% gap down off all-time highs. With that being said, definitely very slow sell-off today. It was very orderly, again, at the top end of the range before the sell-off really starts. Not too surprising. Again, it's just, normal action where if we were, kind of down here, people are kind of freaking out for the last month, different story. But up here, initially very orderly. Some sectors actually closed pretty strong today, but we have, the 660 would be a technical pullback. Pullback would be a 5% drop from the all-time highs. Next up, you have this 620, which would be a technical correction, be a 10% drop. And then this 540 area would be a technical bear market, which would be a 20% drop from, we're just going to call it 700 in the SPY. This bear market drop is the equivalent move of what we saw at the beginning of last year when the tariff wars kicked off. So now with what's been going on, people are talking maybe the tariff war again is going to cause the market to crash. When I say crash, I'm just referring to, bear market drop of 20%. But as much as charts often repeat themselves or they often rhyme, the same fear very rarely is going to be that secondary fear that's going to happen, that's going to cause the next crash. So dot-com bubble, everyone thought dot-com stocks were going to cause the next crash. It was housing. Housing market crashed the market. Everyone thinks housing is going to crash the market again. We have COVID. We have tariff wars. Each time it's something new. And after that thing happens, very rarely is that same fear going to have the same strength as it does the second time around. Even right now, if there was another COVID, most of us aren't going to be freaking out compared to how people acted the first time around. So if this is the second tariff war, which we'll see, if that's going to be the case or not, would not expect this action again because we've already seen what happens, and we also see when it ends, the reverse that occurs. So for right now, just taking it, day by day. But right now, the next key spot is this 670 in the SPY, which is, a pretty insignificant pivot. Really, the key pivot low is this 650. So I'm going to get rid of this pullback, get rid of this. The key pivot right now that we want to see hold is going to be this 650 area. Let's get rid of that for now. This is, this spot is held since September. It's held multiple times. Again, if it gets down here again, this is probably the time where it does break this or shake this area out. But this is kind of like the first line in the sand. If we get this, this is going to be the first area where, kind of buying comes into play. The perfect pullback of 5% at 660 is, the technical area, but doesn't mean it's going to hold there perfectly. So I'm keeping a very close eye on this 650 area to see, do we get down here and do we bounce snap back higher? If we do, the key thing will be, can we put in a new higher high? So if we get a pullback and we can bounce back and touch 700 in SPY, everything's great in the world. If we come in, test 650, bounce, and say come back up to 680 and then form a lower high, then it's that waterfall move lower, which we're going to go over some of the FANG names that we start to see some of that action where this could be the start of a topping pattern. But again, don't want to get too ahead of ourselves. It's just kind of the first warning shot. But again, everything else still technically are within, their relative patterns. Again, the Qs, we've seen this bullish pennant for the last couple of months now. It's getting very tight. And now it's just testing this key support area that it's held since May. Again, if this area breaks and closes below it, by the end of the week, it's a different story. But we saw these last few attempts at this trend line, it does reverse and snap back higher. So we want to keep an eye on a lot of these key levels in the major index. Even right now, if this area breaks, you see a fade back to 580, and then you have more of a traditional bull flag forming horizontally than the pennant that was forming. Moving on to the Dow, again, still very clearly in this bullish channel. Nothing has technically broken. It's just normal. We spent a week or two near the upper end of resistance in this channel. Nothing to really lose sleep. Nothing is broken within this pattern since June. It's not a big deal. Again, rates ticking up a little bit, breaking out of that base that's been forming. Weak dollar, good to see the last couple of days, dollar kind of pulling in. Again, still big base here. Weak dollar, good for stocks. Strong dollar, bad for stocks. Again, put to call ratio, nothing to be alarmed about. And VIX, ticking up a little bit, but really nothing to lose sleep over. These really, the market does get crazy. These are the areas where we really want to be thinking to buy. These are kind of more like the long-term buys when we're buying like in April at the market lows. So very far away from any real scary VIX numbers. It's still, kind of non-existent of a move. Again, strong sectors, semis like the Dow, still very, very much in this broad breakout channel. Nothing, support hasn't been broken. It's just chopping around, nothing to lose sleep over. Again, industrials, industrials basically were at all-time highs last week on Friday, still above the range it was in, still super strong, and nothing really has technically broken that bad. Again, small caps, definitely keeping a big eye on small cap stocks in general for the year ahead. Finally starting to break out of a macro pattern. But again, this is not the time we want to be chasing at all-time highs. Let it pull in, let it set back up. Let this pull back in, let this prior retest area that was resistance for the last couple of years. We want to see that start to turn into support where, like it did the last time, it pulls in, bounces off. We want to see this act as support. And that's when you get those much easier or lower risk entries in that index as a whole. Again, materials breaking out like crazy. Basically insignificant day today. Little doji day again. When you're at, the initial start of any down moves, the market's still very strong. So industrials still look great until we see, break of this very steep uptrend. Consumer staples, again, massive. This is, again, daily candles of the staples and just, rocketed higher. Again, in hindsight, flight to safety, consumer staple names, you're going to still buy toothpaste no matter what the market's doing, where you might avoid, buying a new Tesla, which is going to be more like a discretionary purchase. So again, a lot of the other sectors, I'm going to get rid of a lot of these arrows. Again, this was just kind of highlighting, expecting some chop or expecting some range bound trading in the consumer discretionaries before we see a sustained break higher. Very similar with what we should expect from small mid caps. Same thing. They're finally breaking out of new all-time highs. Consumer discretionaries couldn't break. They finally started to break out here. And now we should expect this broader flag to form within this range. And it takes a couple of months before there's that real sustained push higher. And that's just why there was all those charts or arrows to just visually show, what we should expect. Again, energy still trying to break out, but again, should expect some horizontal price action. Expect this to flag out. It's already, gone a pretty significant way in the last month or two. And this resistance level goes back, nearly 20 years. So this isn't going to be one that just breaks out and never looks back. Again, financials like the Dow, like a lot of the industrials, still very clearly in this bullish channel, and nothing has technically broken. Resistance held up last week, and now it's just fading back into the range, which again, just normal price action. Bio is flagging out. at the retest level. Like the consumer discretionaries, expect that sideways price action, like we're talking about with small caps as well. Healthcare, same story. Again, a lot of these sectors, they look great. They just need time. They've came a long way in the last few months, and now they're settling out and consolidating those gains. So for the most part, for now, a lot of healthy price action. Just, the S&P does look a little bit weaker. Tech today broke, the month of kind of inside weeks that we saw. So we have, inside week and down. So definitely want to avoid the tech names. Again, we were looking for, inside week and up before kind of this geopolitical news. So now it's an avoid. But for now, really want to let this shake out, pull back into macro support, and then you have a much wider range for tech to set up in. Again, telecom broke the low of its little flag. Again, super strong sector as of last week, last couple of days, not the strongest, starting to break down, avoid telecom stocks. And then last but not least, again, utilities, just broadly trying to touch this macro support area. And for now, it's just been an avoid until we see that test of this trend line. So nothing really alarming when it comes to the major indexes. Again, the S&P closing the way it did, probably closed the worst among all the other sectors, where the sector is kind of held up a little bit better. But if we look at some of the FANG names, we can see, I was trying to articulate to the group earlier, a lot of these charts, you'll see, the run up, and then you'll see the breakdown, often very similar price action. So we can, if look like a mirror, this run up in Meta versus the breakdown in Meta, almost identical. You can see, similar consolidation to breakouts, or you see similar consolidations and breakdowns. You can see these like similar kind of topping patterns, breaking down lower. So, just want to articulate, you want to focus on the names when it's the easy time, when it's trending higher, it's forming higher highs and higher lows. It's much easier to find entries through highs and buying through them than names when they're in these breakdown stages where they're just forming lower lows and lower highs, and you're fighting, kind of swimming upstream in a sense. So Meta, very weak. Amazon, very strong bounce last week, but put in that lower high. And that's what I was trying to explain earlier with the S&P. If we get this pullback, we want to see a test of that 700 in the SPY, or 7,000 in the SP 100. For Amazon, we really want to see, when we had this breakout a week or two ago, we want to see that run up to retest the all-time high to confirm that buyers are there. But you got the confirmed lower high, and now you have that start, or what the potential start of what would be more of like a breakdown stage, where you have lower lows, lower highs. And like with Meta, it's just an avoid. So for Amazon, Meta is an avoid. Amazon right now is an avoid, which is the start of what could be, breakdown stage. We got Netflix, massive avoid since the split. We've talked about this for the past couple of weeks. Again, why we avoid names when they split their stock. Again, it's just, window dressing. Nothing really fundamentally changed with the company. It just makes them appear cheaper. And they do this after extreme run-ups in the stock, which Netflix has gone up nearly, 1,000% since, those 2022 lows. So since that split, it's been a void. We can see major support coming in, about, what is this, like $5 lower, but doesn't mean it's going to hold up there. It can easily, blow through this and continue lower. So far, most of these FANG names have been in a void. Google still looks strong, but once this trend does break, this is the overall trend line, and as this run up continues, the trend lines just kind of get steeper and steeper. And when there's no significant support, then you get that. Once this trend line breaks, you slowly get that reversion back to the long-term trend line. So again, it's not to say that it's going to break tomorrow and it's going to be at 220 in a week or two. It could take 6 months to get down there. But the easy times in these FANG names seem to be in the rear view, relatively speaking. Once this trend breaks, you don't want to be fighting Google, the whole way back down. And this is where it just there's just rotation. The way up, you want to keep buying these new highs. When you're not getting new highs, you get new lower highs. You just want to step aside from those names and focus on the ones that are setting up. Again, talking about some of the precious metals. Again, gold definitely led the overall rally. Again, a lot of people are chasing, gold, more so silver, I think, right now. But you don't want to chase the hype. You got to focus on the chart. So we're talking about this gold earlier today. You can see all the macro attempts at this breakout in gold. I'm just going to say 200 an ounce, which really it's like 185, 190. But we go back nearly 20 years. I'm sorry, we're going back about 15 years. So again, gold has done virtually nothing since 2011. So you're seeing a lot of headlines that, gold outperformed the S&P and this and that. It has outperformed it in this tiny window of time where for the last 14 years, it has done nothing but lagged and significantly underperformed. So if you see these headlines, don't let them make it feel like you're missing out, because you're not. Unless you perfectly time this breakout, anytime in the last 14 years, this was a dud. Precious metals were a dud, other than like kind of 08, those flight to safeties. That was the only time they kind of were in play. We're seeing it in play now again. Not the best sign overall for the world when people are climbing into precious metals, but this is more this second leg is kind of the mania of the move. This is the this breakout is what we look for in stocks all day long, which we'll go over Gilead in a moment. We look for this breakout where you're risking, this is 100% move, but your worst case risk is really 5% if you're really waiting for that proper entry. 100% later, anyone buying up here, kind of post this final move super late. And this is where if you're already in it, you really want to just kind of trail these stops once this vertical move ends, like those reversions back to the mean, they happen very quickly. But right now, the wind is to the precious metals back. It's going to continue to push it higher until it doesn't. But this is a monthly chart. And this is, you look back at any of the insane percentage moves, these vertical charts, there's no support on the way down. So once the first area gets taken out, a monthly low, these things revert pretty quickly. So silver is probably a little bit more of a crazier one percentage wise, or, price action wise, percentage wise. Again, silver's really only up, it's up a few 100% off the lows. But again, since 2009, or this is what, 2011. So you bought silver 15 years ago, you broke even 2 months ago, and now you're finally up 50%. You bought the S&P in April, you're up 40% right now. So in 1 year's return, if you timed it correctly, you would have achieved what took someone in silver 15 years to recoup. And again, right now is going to be the only time people talk about it, but that's after the breakout. So these are why you need to focus on the chart, not chasing the headline. So, in my opinion, silver probably runs up to about $100 an ounce. It probably acts as like psychological resistance, just like $50 an ounce acted as psychological resistance for, a decade and a half for silver. So if you're still in it, look for those exits near 100 or do what you got to do. But just know that once this trend reverses, just as fast as they go up, the move back down is equally as fast, because eventually the sentiment changes. There's no one else to chase that precious metal. There's not much more of a story about a metal like gold or silver than just, preserving wealth. It's not like there's going to be a new silver that's going to come out, or Amazon or Tesla is a new roadster that comes out. There's going to be new headlines for the metals. It's just, the fear of, the global economy. And that only lasts for so long. Once you start seeing SPY new highs and everything gets back to normal, you see that flight out of those precious metals. So moving on to some charts. Again, this ASTS, Orlando caught this one last week. Very tight. I'll take that back. This was not tight. Looks tight on the chart, but this was a pretty crazy telecom name. We're keeping an eye on this 100 breakout. He caught it on, I believe that was on Thursday, through 100. Again, it was just these candles look pretty small, but this is like an 8% range. But he caught a crazy gap up the following day, nearly 20% move in 2 days. So again, this is when this name's in play, there's definitely money to be made in that name. This fig again did not work. We took no trade in it. We were keeping an eye on these tight inside days from last week, but broke down and pushed down lower. So no support buyback in that one. Again, continue to avoid that name at all costs. SMCI, what we were talking about from last week, kind of a name that has kind of fallen off the radar after this pull in, but we started to see this base forming. A couple of people who grabbed it from the video we posted last week. So SMCI still starting to break out, a little inside day today. Really, we want to see a break and close above this 32 area. So for right now, 30 seems to be, we have this little inside day. So for now, we want to see a break above 32. Get the little push probably to this like 36 area in the short term. If there's any break below 30 tomorrow and the market continues to be weak, then, look for the exit. We got this AS still, patiently waiting. It's half the game when it comes to these setups, are just waiting for the proper time, waiting for the breakout. So AS still flagging out in this, 10%-ish range. Nothing to do with it testing support. We only care about this break of 40 if and when that time comes. So keep an eye on that. Seeing how some of these credit card names have done after Trump made that announcement of, or asking these card companies to cap interest rates at 10%. Really, JP Morgan has been the only one that's really actively fought that announcement. They debanked Trump allegedly and said allegedly lower interest rates on credit cards would hurt consumers, which is just, they're cuckoo for Cocoa Puffs. So that statement. So expect JP Morgan to face kind of like the backlash of that, that the news cycle on the credit card names, but we're still seeing, American Express still in this channel. Again, if there is a break below this, the breakout channel ends, and more likely either, consolidation or a breakdown stage starts. So if you've been in, American Express for the last, 6 or so months, could be the time to look for the exit. Again, so far, nothing really dramatic has changed. Again, Visa just looks like a massive topping pattern at this time, which they typically do when they're at support, but nothing has technically broken. MasterCard technically hasn't broken. It's still, MasterCard and Visa both in their, relative bull flags, you can say, or topping pattern. American Express still in the bullish channel. COF still in its bullish channel. So none of them have technically broken yet, but once you start to have that negative news cycle on this sector, it's just going to add some downward pressure onto it. So these are definitely not ones you want to be running into at the moment. If you're in them, it's not rushing out immediately, but trying to know where those key spots are to get out if this is going to have a longer term effect on this little subsector as a whole. So again, just something about why we don't want to chase metals or chase what's in the news. Last week, or 2 weeks ago, we saw a big run up in the home builders when Trump started announcing he was buying some mortgage-backed securities. But again, you don't want to be chasing the 10% run up. You got to let these things settle out. 10% run up in the sector is a massive run up as a whole. Again, some of this pullback is probably just overall market related. But when you chase these things at the end of the move after they've happened, this is often what happens. It's like for the people that are going to be chasing silver right now, after 100% run up in a month or so, when you're late to the party, you might get rewarded for a couple of days, but eventually with time, they revert to the mean. It gets costly. So keep an eye on a couple of names. Again, we're going up to Vermont on Thursday throughout the weekend. So I won't be too active. Still keep an eye on a small set of names. Again, this LIVN, small cap healthcare name, very textbook bull flag, closed very strong today. Market is very weak. Healthcare is pulling in. This healthcare name doesn't care. Closed the day near highs. So still flagging out. 64, 65 are the two kind of key areas in this breakout. Just keep an eye on that one. Again, sticking with the healthcare theme, UNH closed, up 2% today when the market closed down 2%, definitely showing some relative strength. We can see, this is when, they had all the lawsuits, UNH, and it seems like for now, we're seeing this very tight consolidation over the past couple of months. So keep an eye on this UNH. There's multiple entries here. You got 340, you got 350, you got 375. So a lot of entries in this, a lot of potential entries in this name. Key out seems to be like this 320, 324 area. So keep an eye on that. We got this triple R. Again, just textbook bull flag, setting up through this 64 versus 60. Again, not the best close, but again, we just care for if and when gets back up to this 64 area. Last but not least, MEDP. Multiple attempts at this 625 area. Tested it last week. Wasn't ready just yet. No big deal. Pulls back in. Still very textbook flag forming here. So keep an eye on this MEDP and also this Gilead. So if we zoom out a bunch here, again, going back nearly 10 years, it's taken Gilead to get back to all-time highs. 10 years later, it's back up here. It took a long time. Again, this is decade is a long time to be holding a name. So we're just seeing, Gilead continuing to form, again, this is a monthly here, but very consistent higher lows. I'll switch over to like a weekly, very defined uptrend. And it has started to break out this like 121 area was that resistance going back, nearly 10 years. So that area that was resistance is now starting to act as support. And this is like, we're talking about that gold, remember that 10-year pattern that took to set up. Resistance, resistance, resistance. And then the area starts to act as support. And once it starts to act as support, that is when the name finally starts to break out. And then it really starts to go. Now we're looking at it, year and a half later, nearly 100% higher. So same with this Gilead, it takes 10 years to get back to highs. This is resistance. And recently, that resistance area, again, it's not going to be perfect, but you can start to see now it's starting to slowly act as support. So I'm not trying to buy this on the way down. I'm not trying to buy this perfectly down through these lows. But now, just like with gold, if it's going to break out higher, it has to push through the all-time highs. And that's really when the path of least resistance starts to get into place. So like right now, this could do this for months. This could chop around here for the next 6 months and tire people out, just like gold did that for years. But then it spent a month or two very tightly trading in this range. And then it finally, this is that prior resistance area. And then again, I got to really zoom in here to show the breakout. But once it really goes, it never looks back. So Gilead is showing us kind of the same action like right here. We just haven't gotten this part yet. We haven't gotten that like back-to-back week breakout. And that's why I don't want to get into this theme too soon. And then you're stuck chop around in it for a few months. And again, a move to 130 back to 115, it's still a significant, this isn't like a tight 1% risk trade. You might have to risk 5 or 10% in it. But if you can give it a year or so, like we saw with gold, again, it's not going to work out exactly the same. But these are very high probability trades if you can wait for the proper entry. And then once you get that, be patient enough to stick with it. Meaning, like Tesla, we sat with that name for months. I finally started to get out of it last week. We got this very nice entry. and we got 140% move or 140 point move in the name. We didn't, top ticket at 500, but you had to sit with it and give it the time to see what it could do. And it's now just starting to break the trend line that has held since April. And now it's kind of telling us like maybe this thing has to pull back. Maybe it has to come back to 360 and let this area turn into support before it's going to really see a significant break above 500. So same with this Gilead, rather just wait for the confirmation of this breakthrough, this 128, give it the right room versus the weekly low, and know that this is a name where you want to hold it for months on end. You don't want to be watching it every day because it's just going to trip you up. So, right now for this rest of the week on the active side, less is more. If you're in cash, hang out in cash, let the market settle out. Really want to see a gap down and reversal. You don't want to, like, the market's not going to gap up and then that prior low be the low. You really want to see that gap down and reversal back higher for whatever is going to be that short-term bottom. So keep it light. Again, long-term wise, big picture M1 models, continue to do what you've been doing. Don't change that. And any questions you guys have, post them in the comments below and we'll gladly go over them. Thank you.